All right, welcome to the deep dive. You know how sometimes you pick up a crucial report and it feels like it's written in, I don't know, some kind of secret code
Mhm.
full of jargon and obscure pronouncements?
Yeah, definitely. They could be dense.
Well, today we're going to crack one of those codes wide open. We're doing a deep dive into the truly vital world of integrated audit communications and reporting,
Uh,
our mission, to demystify who says what, to whom, and when, especially when it concerns a company's internal controls. Now, you might think this sounds a bit dry,
it can sound that way at first glance, yeah.
but trust us, by the end of this deep dive, understanding these communications will feel like having a superpower for evaluating a company's financial health.
Indeed. We'll be pulling apart the layers of some of the most crucial documents in corporate governance, the audit communications and reports to reveal their vital insights.
Okay.
We're going to focus on how auditors communicate deficiencies, what the different levels of these deficiencies actually mean, and crucially, how these findings are formally reported. We'll also pay close attention to the distinctions between non-issuers and issuers, which essentially means we'll explore how private and public companies navigate these critical reporting requirements and, why those differences matter so much.
So, if you've ever wondered what an auditor actually does beyond just signing off on numbers,
Mm,
or why these seemingly technical reports are so profoundly important to anyone scrutinizing a company, you're absolutely in the right place. Consider us your financial detectives for the next little while. Let's unpack this.
let's do it.
Okay, let's begin our investigation by understanding the fundamental findings auditors uncover. Imagine an auditor as a seasoned financial detective, right? Meticulously sifting through clues about how a company handles its money internally.
Exactly.
When they find something amiss, a sign that the system might not be working perfectly, their first step is to tell the right people. But this isn't just a casual chat over coffee, is it? It's a highly formalized process.
Oh, absolutely not. Exactly. When auditors are performing an integrated audit, meaning they're simultaneously auditing both the financial statements and, critically, the internal controls over financial reporting.
Right, the integrated part.
Yeah, that part. Their findings, particularly those concerning weaknesses in internal controls, must be formally communicated. This isn't just about, sharing information casually.
Uh-huh.
It's about establishing accountability, making sure that those responsible for the company's operations and governance are fully aware of potential risks, and providing a transparent record.
Okay.
We'll first examine the rules for non-issuers, which are typically private companies, before moving to issuers, which are public companies.
Gotcha. Private first, then public.
Right. This sequential approach is important because the regulatory environments for private versus public entities impose slightly different, yet equally critical, communication requirements and, different levels of public scrutiny.
Okay, so our financial detective has found some clues. When it comes to internal controls, what exactly are we talking about when we use terms like deficiency, significant deficiency, and material weakness? These terms sound like they're on a spectrum of seriousness.
They absolutely are.
But what really differentiates them? How bad is bad?
That's a truly important question, and you've hit on a critical point.
Mm,
They are definitely on a spectrum, and understanding the precise nuances between them is fundamental to grasping the auditor's findings and their potential impact. Let's start with a deficiency in internal control. This exists simply when a control isn't designed or operating properly.
okay, the basic level.
Exactly. Think of it like a tiny, perhaps almost imperceptible crack in a foundation, or maybe a minor procedural oversight in a process.
Hmm.
It means the control doesn't allow management or employees, in the normal course of doing their jobs, to prevent or detect misstatements in a timely manner.
So an example might be,
Well, it could be a small spreadsheet error that gets caught manually a few days later, or maybe a missing signature on a low-value purchase order. It's a flaw, yes, but often one that doesn't immediately jeopardize the entire financial structure. It might be an isolated thing
yeah.
or quickly correctable.
Okay, so not necessarily a disaster.
Not necessarily. Now, let's scale that up a notch to a significant deficiency. This is a combination of deficiencies, or even a single deficiency, that is less severe than a material weakness.
Right.
But it's still important enough for those charged with governance, like the board or audit committee, to pay serious attention.
So worth flagging to the higher-ups.
Definitely. It indicates a more substantial breakdown or weakness in the internal control system. Think of it as a bigger crack in that foundation.
Okay.
While it may not directly cause a material misstatement in the financial statements on its own, it signals a systemic issue that warrants serious consideration and fixing because it could potentially lead to errors if left unaddressed.
Like what, for instance?
Um, Imagine consistent delays in reconciling intercompany accounts across several departments. It leads to minor errors that maybe aren't material individually, but they indicate a broader procedural problem.
Ah, I see.
Or perhaps there's a lack of proper segregation of duties in a non-critical area that, while not immediately disastrous, creates an unnecessary risk exposure. It's a warning sign, basically, a structural weakness that needs attention before it grows.
Got it. A bigger crack needs watching.
Precisely. Finally, we arrive at the most serious level, a material weakness.
Okay, the big one.
This is a deficiency or a combination of deficiencies where there's a reasonable possibility that a material misstatement in the financial statements won't be prevented or detected on a timely basis.
Reasonable possibility. So not guaranteed, but a real chance.
Exactly. If the foundation has a material weakness, the entire building could be at risk of collapse. It means the flaw is so pervasive or impactful that it could reasonably lead to the company's financial statements being wrong in a way that would significantly influence a reasonable investor's or stakeholder's judgment.
Okay, that sounds serious, like fundamentally serious.
It is. Imagine a company consistently failing to reconcile its main bank accounts, allowing large discrepancies to go unnoticed for months.
Yikes.
Or consider a complete absence of oversight over its revenue recognition process, making it impossible to confirm if reported sales figures are accurate. These aren't just cracks, they are, gaping holes that could easily lead to major financial reporting errors, directly impacting trust, valuation, maybe even legal standing.
Got it. So a sliding scale from a minor glitch, a deficiency, up to a significant deficiency, which is a warning, all the way to a material weakness, which is a fundamental structural flaw.
That's a good way to put it.
So for these more serious issues, significant deficiencies and material weaknesses, what's the auditor's obligation to communicate for these non-issuers, these private companies? Is it just a casual heads up or something far more formal?
Oh, it's far more formal. For non-issuers, the auditor must communicate all significant deficiencies and material weaknesses in writing.
In writing. Key point.
Yeah, absolutely key to both management and those charged with governance. This typically refers to the board of directors, the audit committee, or equivalent individuals responsible for overseeing the company's strategic direction and financial reporting.
Right.
This written communication is non-negotiable. It serves as a formal record of the identified weaknesses, establishing clear accountability.
And the timing, when does this have to happen?
Generally, it needs to happen by the report release date, which is the date the audit report itself is issued. This timing is crucial, as it ensures that the key stakeholders are fully apprised of these critical findings before the audit opinion is formally disseminated to other parties, like lenders perhaps.
Okay. And what if they've already been told about something before? Maybe last year's audit? Or what if the company actually fixes the issue during the audit? Do they still have to write it down again? That seems kind of redundant if it's already resolved.
Yeah, it might seem redundant at first glance, but the formality and documentation are absolutely crucial for accountability, transparency, and, well, future reference. Even if a deficiency was previously communicated in writing but remains uncorrected, the auditor can simply refer to that prior communication and its date rather than re-describing it entirely. So that saves some effort.
Makes sense.
However, and this is the critical part, if deficiencies are corrected during the integrated audit, a formal written communication is still required.
Still required, even if it's fixed.
Yes. The auditor can choose to communicate these matters earlier, perhaps verbally as they are discovered, but this does not negate the ultimate requirement for a formal written communication. This ensures that a complete and audible record of all identified significant deficiencies and material weaknesses, whether remedied or not, is provided to management and those charged with governance.
Ah, okay. So it underscores the auditor's diligence and provides proof of remediation if applicable.
Exactly. It creates that clear paper trail.
Fascinating. So it's really about documenting everything formally for a complete record. I noticed the source includes a sample communication letter. What stands out to you in that formal letter? What are the key messages it conveys beyond just, listing the problems?
Well, what's truly fascinating there is the precise language used in that sample communication. It's far more than just a list of findings. It's a carefully structured document that really sets the context, defines responsibilities, and manages expectations.
How so?
The letter clearly defines the auditor's responsibility to plan and perform the integrated audit to obtain reasonable assurance.
Reasonable assurance, not absolute.
Correct. Reasonable assurance about whether financial statements are free from material misstatement and whether effective internal control is maintained in all material respects. This explicitly clarifies that the audit aims for a high but not absolute level of assurance.
That seems like a really important distinction for people to understand.
It's critical. An audit provides a strong degree of comfort, but it's not a guarantee against every single error or fraud, especially those involving, say, collusion or management override.
Right.
It also explicitly states that the audit isn't designed to detect deficiencies that, individually or in combination, are less severe than a material weakness.
Managing expectations again.
Exactly. It sets clear expectations from the outset, managing the recipient's understanding of the audit's scope and its limitations regarding those lesser issues. It's essentially saying, we looked for the big problems, and if we stumbled upon smaller ones, we'll tell you. But we didn't go digging for every tiny crack.
Okay.
Furthermore, the letter rigorously defines what constitutes a deficiency, a material weakness, and a significant deficiency, ensuring a common, unambiguous understanding of these critical terms for all parties.
Standardization.
Right. And when describing identified material weaknesses and significant deficiencies, it emphasizes the need to provide explanations of their potential effects.
Not just what it is, but what it could do.
Precisely. This is crucial because it helps management and the board understand the practical implications and risks associated with these findings, not just the technical details.
Makes sense.
And finally, the letter contains a crucial limiting paragraph that clarifies its intended audience. It basically says, this communication is intended solely for the information in use of management, the board, others within the organization, and maybe specific government authorities, and is not intended to be and should not be used by anyone other than these specified parties.
So keeping it internal for these private companies.
Exactly. It underscores its confidential and targeted nature, making it clear that this specific communication is not for general public consumption. It reinforces that this is an internal private dialogue about internal health.
Okay, so we've covered the big ones, significant and material weaknesses, which require that formal, timely written communication. But what about all the little cracks? Do auditors have to report those too, even the minor ones that don't quite hit the significant level for these non-issuers?
Yes, they do, but with a slightly different nuance and timing. For non-issuers, the auditor must communicate all identified deficiencies, even those less severe than significant deficiencies or material weaknesses, directly to management, in writing.
All of them, to management.
Yes, all the ones they identified during the audit. This broad requirement ensures that management is fully aware of every identified control weakness, regardless of its perceived severity. It's about providing a comprehensive picture of the control environment as observed during the audit.
Okay. And the timing is different, you said.
Right. This communication for these lesser deficiencies has a slightly different timeline compared to the more serious ones. It should be made no later than 60 days following the report release date.
So a bit more breathing room there.
A bit more, yeah. And while this specific communication is directed primarily to management, those charged with governance must also be informed that such a communication has been made, so the board knows management got this list.
Okay. Do they have to repeat them every year?
Not necessarily. Deficiencies that are previously communicated in writing in prior periods don't necessarily need to be repeated in subsequent communications, which avoids unnecessary duplication while still maintaining a comprehensive record over time.
So essentially, every single issue the auditor finds, big or small, gets documented and communicated to management. That sounds like potentially a lot of detail, maybe even overwhelming for management.
It can indeed be a lot of detail, but it ensures management has that complete picture of all identified control weaknesses to help them prioritize remediation efforts. However, this raises an important distinction we touched on earlier.
Which is?
Auditors are not required to specifically search for control deficiencies less severe than a material weakness.
Right. They aren't hunting for tiny cracks.
Exactly. Their primary objective during an integrated audit is to obtain reasonable assurance that no material weaknesses exist and that the financial statements are free from material misstatement. But if they happen to identify these lesser deficiencies during the course of their audit procedures, maybe while testing other more significant controls, then they must report them.
So if they stumble upon it, they report it.
Correct. It's a critical distinction.
Yeah.
They don't have to go actively looking for minor issues beyond the scope of their primary objectives, but they can't ignore them if they find them.
Okay.
And this leads to a really key point. An audit does not provide assurance that all deficiencies less severe than a material weakness have been identified.
Because they weren't specifically looking for all of them.
Precisely. Because the audit isn't specifically designed to ferret out every minor flaw, the auditor cannot make a blanket statement that no such minor deficiencies exist. Therefore, an auditor should never issue a report stating that no such deficiencies were noted, as that would imply an assurance beyond the scope of their work.
That makes sense.
Similarly, they shouldn't issue a report stating no material weaknesses were identified if that's not explicitly their opinion based on the evidence. It's about being incredibly precise with the level of assurance provided and the scope of the findings to avoid misleading anyone who reads the report.
That makes perfect sense. It's about reporting what you find, not guaranteeing perfection or an exhaustive search for every minuscule flaw.
Okay, but what if the people overseeing the finances, like the audit committee or the board in a non-issuer context, aren't doing their job effectively? Is that something an auditor comments on, or is that kind of outside their purview?
Oh, that is indeed a very serious finding, and it absolutely requires communication. If the auditor concludes that the oversight of financial reporting and internal control by the company's audit committee or a similar body is ineffective,
Which is a huge problem.
a fundamental problem, then they are required to communicate that conclusion in writing to the board of directors.
Wow. Directly to the board about the audit committee itself. Yes. This is a very serious communication because the audit committee is supposed to be a cornerstone of corporate governance, providing that independent oversight. A finding of ineffectiveness in their role signifies a fundamental breakdown at the highest level of internal control, directly impacting the integrity and reliability of the entire financial reporting process.
That's a critical red flag for the company's governance structure itself.
Absolutely.
Now, let's shift our detective work. Let's talk about issuers' public companies. With their accountability to millions of public investors and the heightened transparency demands, do the same rules apply as for private companies, or are there different expectations? Does that public scrutiny demand something more?
Well, there are key similarities, but also profoundly important distinctions due to that heightened public scrutiny and the robust regulatory environment for public companies, largely governed by the PCAOB.
Okay.
For issuers, the auditor must communicate all material weaknesses identified during the audit in writing to both management and the audit committee.
Okay, similar start, but the timing.
The timing is different and absolutely crucial here. This written communication is explicitly required prior to the issuance of the auditor's report on internal control over financial reporting.
Before the public sees the report.
Exactly. This ensures the audit committee, as the primary oversight body for public companies, is aware of the most significant issues before the public report is released to the market. It allows them to take immediate action or, prepare for market reaction.
Makes sense. What about significant deficiencies?
Significant deficiencies must also be communicated in writing directly to the audit committee.
Directly to them, not just informing them it went to management.
Correct. This direct formal communication to the audit committee for significant deficiencies highlights their more active and direct role in overseeing internal controls for public entities. They have a more immediate and direct responsibility under the regulations. And similar to non-issuers, all deficiencies of a lesser magnitude than material weaknesses must be communicated to management in writing, with the audit committee simply informed that such a communication has been made.
So that part's the same.
Right. The tiered communication structure remains, but with greater emphasis on direct, timely reporting to the audit committee for the higher severity issues, reflecting the increased stakes for public companies.
So the communication flow is similar in structure, but the audit committee definitely gets more direct and immediate reporting for issuers. It seems like their role is indeed far more prominent and critical in the public sphere.
Precisely. The role of the audit committee is often much more formalized and central for public companies. They serve as a critical liaison between the external auditor and the full board, and often act as the primary point of contact for internal control oversight, as mandated by bodies like the PCAOB. And, just like non-issuers, if the auditor finds the audit committee's oversight of internal control and financial reporting ineffective, that severe conclusion must be communicated in writing to the full board of directors.
Still that same critical safeguard.
Yes, it's a fundamental safeguard, ensuring that even the ultimate oversight function itself is subject to scrutiny and formal reporting when found deficient. For a public company, this finding can have incredibly serious repercussions, indicating a breakdown at the very top.
Okay. Now, are auditors required to search for all deficiencies for issuers then, given the higher stakes and public accountability? Or does the same rule about not actively searching for minor issues still apply?
No, the principle remains consistent here as well. The auditor is not specifically required to search for control deficiencies or significant deficiencies less severe than a material weakness,
Even for public companies.
even for public companies. However, any that are identified during the course of the audit must be communicated, following the rules we just discussed. The audit of internal control for an issuer, while comprehensive and rigorous, is still primarily designed to identify material weaknesses that could impact the financial statements.
The big stuff.
Right? The big stuff, not necessarily every single minor control flaw. Therefore, an audit for an issuer also doesn't provide assurance that all control deficiencies or significant deficiencies have been identified.
So the report shouldn't say no problems found for the smaller stuff.
Exactly. Consequently, reports should always avoid stating that no such lesser deficiencies were noted, again to prevent misrepresenting the scope and limitations of the audit work. This distinction is vital for anyone interpreting an audit report, as it clarifies what the auditor is and isn't providing assurance on, and helps manage investor expectations realistically.
It's interesting, though, that the PCAOB, which sets standards for public company audits, hasn't provided specific sample communications for issuers, unlike the non-issuer samples we saw referenced in the source. Does that suggest a bit more flexibility, perhaps, in how these internal communications are formatted for public companies?
Well, it simply means they haven't prescribed a specific template or boilerplate language. It doesn't necessarily imply more flexibility in the content itself.
Ah, okay. The substance is still mandated.
Absolutely. The requirements for what must be communicated remain crystal clear and are strictly enforced. The exact format might be left to the auditor's professional judgment to tailor to the specific circumstances of the issuer, but the core information has to be there.
So it allows for maybe adaptability in presentation while still upholding those strict communication mandates.
Precisely. The focus is on the substance of the communication, ensuring all necessary information gets conveyed to the right parties in a clear and effective manner, rather than just adherence to a rigid template.
Okay, moving beyond the confidential letters and detailed internal communications. The ultimate deliverable, the pièce de résistance, is the audit report itself. This is where the auditor formally expresses their opinion, and it's what most people think of when they hear audit.
Right, the public face of the audit in many ways.
Exactly. For our non-issuers, our private companies, what does this final formal document look like? What are the options?
For non-issuers, the auditor is required to report directly on the effectiveness of the entity's internal control over financial reporting. This report is distinct from, but intricately related to, the report on the financial statements.
Okay.
Now, this can be done in one of two ways, either as two separate reports or as one combined report.
Separate or combined?
Right. The choice between these two formats often comes down to practicality, maybe tradition or the client's preference. But the content and underlying opinions remain consistent. They're based on the same rigorous audit work.
So two different pieces of paper or one big one. What's the practical difference for the auditor and, maybe more importantly, for the reader trying to understand the company's financial picture? Does it change the message at all?
Well, if separate reports are issued, you'd find one report dedicated solely to the financial statements and another separate report dedicated just to internal control over financial reporting.
Okay, distinct documents.
Yes. And each report will contain a paragraph within its opinion section that explicitly refers to the other report and indicates the nature of the opinion expressed in that other report.
Ah, like a cross-reference.
Exactly. It's a crucial cross-reference that helps connect the two, even if they're distinct physical documents. It ensures that a reader picking up, say, just the financial statement report is immediately made aware that there's another related opinion available on internal controls, providing a more complete picture.
It's like having two expert opinions that reference each other.
That's a good analogy. Now, a combined report, on the other hand, contains both an opinion on the financial statements and an opinion on internal control within a single integrated document.
All in one place.
Right. From a reader's perspective, this can be quite convenient, as all the auditor's formal conclusions are presented together, offering that holistic view without needing to consult multiple documents. It's often the preferred format just for ease of reading.
Seems simpler.
It can be. Functionally, for the auditor, the underlying work to form both opinions is the same, regardless of the reporting format. The combined report simply merges the formal expression of those opinions into a single, comprehensive presentation.
Let's really dive into what's actually in these reports, whether they're separate or combined. The source provides some sample language. As our financial detectives, what are the core sections we, as the listeners, should be looking for? What's the critical information in each part that paints that true picture of the company's internal health?
Okay, good question. Regardless of whether it's separate or combined, a standard audit report on internal control will typically have several key sections. Each serves a specific, vital purpose in providing transparency and context to the auditor's opinion. These sections guide the reader through the process, clarify who's responsible for what, and articulate those important limitations.
All right, break it down for us.
First, you have the opinion on internal control over financial reporting. This is the heart of the report, the main
Well,
conclusion.
bottom line.
Essentially, yes. It states the auditor's ultimate conclusion on whether the company maintained effective internal control over financial reporting as of a specific date. For a non-issuer, assuming a clean or unmodified opinion, it might read something like, in our opinion, ABC Company maintained, in all material respects, effective internal control over financial reporting.
So a clean bill of health on the operational plumbing.
Pretty much. Next is the basis for opinion section. This explains how the auditor arrived at their opinion. It provides the foundation for their conclusion.
The how we got here.
Exactly. It states that they conducted the audit in accordance with generally accepted auditing standards, or GIS. You can think of GIS as the auditor's comprehensive playbook, the rigorous set of professional standards guiding their work.
Uh-huh.
It also emphasizes that the auditor exercised professional judgment, maintained professional skepticism throughout the audit, meaning they approached everything with a questioning mind.
Right. Didn't just take things at face value.
Correct. And believes the audit evidence obtained is sufficient and appropriate to provide a basis for their opinion. This section gives immense credibility to the opinion by outlining the rigorous process behind it.
Okay, what else?
Following that, we have the responsibilities of management for internal control over financial reporting. This section is crucial for clarity. It clarifies that management is primarily responsible for designing, implementing, and maintaining effective internal control.
Management owns the system.
Right. It also notes that management is responsible for their own assessment about the effectiveness of internal control, which is typically included in a separate management report accompanying the auditor's report. This clear separation of responsibilities is critical. The auditor is providing an independent opinion on management's assertion about internal controls, not designing or maintaining the controls themselves.
Okay, management's job versus the auditor's job?
Exactly. Then comes the auditor's responsibilities for the audit of internal control over financial reporting. This section outlines what the auditor actually did.
Their scope of work.
Precisely. It explains that their objectives are to obtain reasonable assurance about whether effective internal control was maintained in all material respects and to issue an auditor's report that includes their opinion. It specifies that they exercise professional judgment, maintain professional skepticism, obtain an understanding of internal control, assess the risks of material weakness, and test and evaluate the design and operating effectiveness of those controls.
So what they actually tested.
Right. And crucially, it reiterates that reasonable assurance is a high level of assurance, but is not absolute assurance, that vital limitation again. It reminds users that even a thorough audit isn't a 100% guarantee against all possible errors or fraud.
Okay, that makes sense. Reasonable, not absolute.
And then there's a section on definition and inherent limitations of internal control over financial reporting. This is a particularly important one.
Okay, wait. Inherent limitations. That sounds like a disclaimer, almost like a, we tried our best, but what exactly does that mean for someone reading the report, and why is it so important for understanding the auditor's opinion? It sounds potentially worrying.
Yeah, it can sound that way, but it's actually a really crucial piece of context. And as the source notes, this inherent limitations paragraph is often a focus for examiners, indicating its critical importance. This section serves two key purposes. First, it provides a definition of internal control over financial reporting. Essentially, a process designed to provide reasonable assurance regarding the preparation of reliable financial statements. It outlines what internal control includes, like maintaining detailed records, ensuring transactions are authorized, safeguarding assets.
The building blocks.
Right. It explains that these controls are about providing reasonable, not absolute assurance, because absolute assurance is simply unattainable in complex human systems. Then, immediately after this definition, it outlines the inherent limitations, which are absolutely critical for any user of the report to understand fully.
Okay, what are these limitations?
It states that internal control, just by its very nature, may not prevent or detect misstatements due to factors like, well, human error. People make mistakes.
Unavoidable.
Pretty much. Or collusion between individuals, where two or more people conspire to bypass controls.
Right, people working together to cheat the system.
Exactly. Or management override, where those in power intentionally circumvent existing controls, making them ineffective.
Okay.
It also highlights that projections of effectiveness to future periods are subject to risks, like changes in conditions or deterioration of compliance over time. Controls can become outdated, or people can stop following them.
So things change.
Right. This means even a perfectly clean audit opinion on internal controls isn't a guarantee against all future problems. It's an assessment at a specific point in time based on the controls in place then, subject to these built-in, unavoidable limitations. It reminds us that no system is foolproof.
So it manages expectations about what an audit can truly guarantee.
Precisely. It prevents misinterpretation of the auditor's opinion as an absolute, eternal guarantee of future flawless operations. It's just a pragmatic recognition of reality.
Got it. Okay, what about the date on the report? Is there a specific date an auditor's report must be issued? Or can it be backdated or issued whenever the auditor feels like, all the documents are finally in order?
No, there are strict rules for the report date. The report should be dated no earlier than the date on which sufficient appropriate audit evidence has been obtained.
Meaning all the work is done.
Right. The auditor must have completed all necessary procedures, gathered enough reliable evidence, and formed their opinion before they date the report. It's the culmination of their work.
Okay.
Importantly, the date of the report on internal control should coincide with the date of the audit report on the financial statements.
Same date for both.
Yes. This ensures consistency between the two opinions, as they are typically performed as an integrated audit and rely on a shared body of evidence up to that point. It signifies that all necessary audit work related to both the financial statements and internal controls has been completed as of that precise date. That synchronicity provides a clear point in time for the assessment.
Okay. So let's go back to the bad news scenario. If our financial detective does find a material weakness, the most serious kind of deficiency we talked about, what happens to the opinion in the report? Does it still say the controls are effective, maybe with a footnote or something? Or is it a fundamental change to the whole message?
Oh, it's a fundamental change. Not at all just a footnote. The presence of a material weakness in internal control directly results in an adverse opinion.
Adverse. That sounds bad.
It is. It's the strongest negative opinion an auditor can issue regarding internal controls. It fundamentally states that the company has not maintained effective internal control over financial reporting as of the specified date.
Wow. So a straight-up failure.
Essentially, yes. An adverse opinion signals a flashing red light to all users, investors, lenders, business partners that there are significant, pervasive problems with the company's control environment that could lead to material misstatements in the financial statements.
Okay, so how does the report reflect that?
The auditor's report must include a specific paragraph defining material weakness, reiterating its significant nature. That reasonable possibility that a material misstatement won't be prevented or detected on a timely basis.
Right.
It will then explicitly state that one or more material weaknesses were noted and specifically refer to the material weakness described in management's own assessment, usually by title or reference.
Okay.
The opinion paragraph will then unequivocally state that because of the effect of the material weakness, the company has not maintained effective internal control over financial reporting. That clarity leaves absolutely no room for ambiguity about the severity of the finding. Its implications are undeniable.
And what if management's own report isn't quite accurate about these weaknesses? Like if the auditor finds a material weakness, but management conveniently leaves it out of their own assessment or maybe tries to downplay it, how does the auditor handle that?
That's a great question, and it's a critical scenario where the auditor's independence is paramount. If management's report fails to include a material weakness identified by the auditor's report must state this fact and then proceed to describe the omitted weakness in detail within their own report.
So the auditor corrects the record, essentially.
Exactly. It ensures that even if management tries to downplay or hide a serious issue, the auditor's report will unequivocally bring it to light for all users. This situation also needs to be communicated separately, in writing, to those charged with governance, as it signals a potentially significant breakdown in management's own reporting.
Right.
Similarly, if management's report includes a material weakness but doesn't fairly present it, maybe it minimizes the impact or doesn't fully describe the scope, the auditor's report must indicate this and then fairly describe the weakness themselves, providing the unvarnished truth.
Okay. And does this bad opinion on controls affect the opinion on the financial statements themselves?
Well, the auditor has to consider that effect. An adverse opinion on internal controls doesn't automatically mean an adverse opinion on the financial statements,
Oh, interesting. Why not?
because the auditor might have performed extensive additional testing, what we call substantive procedures, to compensate for the control weaknesses and satisfy themselves that the financial statements are still fairly presented, despite the weak controls.
Ah, okay. They did extra work to check the numbers directly.
Right. But the auditor's report must indicate whether the financial statement opinion was affected by the material weaknesses in internal controls. This ensures a comprehensive and accurate picture for the reader about both the financial figures and the reliability, or lack thereof, of the underlying control environment that produced them.
Okay, let's bring it back to the issuers, the public companies. We touched on some differences for them earlier in terms of direct communications to the audit committee. Now, what about the nuances in their formal audit reports, specifically regarding their internal control reports? Are the basic options of separate versus combined reports still on the table for them, just like for non-issuers?
Yes, they are. For issuers, similar to non-issuers, the auditor is required to report on both the company's financial statements and its internal control over financial reporting. And yes, the option to issue two separate reports or one combined report still exists.
Okay, so that structural choice is consistent.
Right. It provides flexibility in how the information is presented to the users, whether they prefer a unified document or distinct reports covering financials and controls.
So the choice between separate or combined reports exists for issuers too, and presumably the cross-referencing logic is similar if they choose separate reports. They point to each other.
Yes, the option is exactly the same, and the cross-referencing is consistent. If separate reports are issued, each report will contain an explanatory paragraph making reference to the other report and indicating the nature of the opinion expressed.
Okay.
This helps ensure that anyone reading one report is made aware of the existence and opinion of the other, providing that complete audit package. For combined reports, both opinions are presented within one document, offering a unified perspective, which, again, can be particularly convenient for public investors accessing this information through regulatory filings.
Right. Are there other differences in the issuer reports?
Well, while structurally similar to non-issuers in terms of sections like opinion, basis for opinion, and definition and limitations, the sample reports for issuers do have some key differences in specific wording that reflect their unique, more stringent regulatory environment.
Like what?
For example, they often refer to control criteria established by bodies like the Committee of Sponsoring Organizations of the Treadway Commission, or COS.
QSO, yeah, you hear that a lot.
Right. It's a widely recognized framework for internal control. And the reports explicitly mention that audits are conducted in accordance with the standards of the Public Company Accounting Oversight Board, the PCAOB.
Ah, highlighting the specific public company rules.
Exactly. It highlights that issuers operate under that more stringent public oversight framework, and the reports explicitly acknowledge adherence to these specific standards and regulatory bodies, which is critical for public trust.
So the fundamental definitions and those inherent limitations of internal control, they're consistent across both public and private companies, even with the different regulatory bodies and heightened scrutiny. It sounds like those are just universal truths in auditing, regardless of company type.
Yes, you've hit on a core truth there. The fundamental definitions and inherent limitations of internal control over financial reporting are described consistently for both issuers and non-issuers.
Why is that?
Because these concepts are intrinsic to the nature of internal control systems themselves, regardless of whether a company is public or private, the reports consistently emphasize that the process provides reasonable assurance, not absolute, and is subject to universal limitations like human error, management override, or changes in conditions.
Right.
This consistent language about limitations is crucial for all users, reminding them that no system, no matter how well designed or diligently audited, is completely foolproof against all potential misstatements or breakdowns. It's just a vital piece of context for any financial health check.
And the report date rules. Are they the same for public companies with that critical timing aspect you mentioned earlier for non-issuers? Does it have to be the same day for both reports?
Identical. The report date for issuers should be no earlier than the date on which sufficient appropriate evidence has been obtained.
All the work's done.
Right. Ensures the auditor has completed all their work and gathered all necessary evidence before formally issuing the report. Furthermore, the internal control report date must coincide with the financial statement audit report date.
Still synchronized.
Absolutely essential, because the internal control audit is an integral part of the overall integrated audit for issuers. Having consistent dates reinforces that both opinions are issued simultaneously, reflecting the culmination of the audit procedures performed up to that point for public disclosure.
Okay. We know a material weakness leads to an adverse opinion for non-issuers, that clear red flag. Is it the same for public companies? Does that red flag immediately appear on their internal control report for all investors and the market to see?
Absolutely. The identification of a material weakness unequivocally requires the auditor to issue an adverse opinion for an issuer as well. This is a critical public red flag.
No hiding it.
None at all. It signals to the investing public and other stakeholders that the company's internal control over financial reporting is not effective in preventing or detecting material misstatements. The report must include the definition of a material weakness, clearly state that one has been identified, and specify that the entity's internal control is therefore not effective.
Okay.
It also identifies the material weakness as described in management's assessment, similar to the non-issuer reporting. This ensures consistency and transparency in reporting the most severe control deficiencies straight to the market.
And the impact for a public company.
Oh, for a public company, an adverse opinion on internal controls can have immediate and significant repercussions on its stock price, its reputation, its ability to raise capital. It's a major event.
Right. And the considerations about management's report being inaccurate if they leave out a weakness or misrepresent it, those rules are the same for issuers too. The auditor has to correct the record.
Precisely the same. If management's assessment does not fully disclose a material weakness identified by the auditor must explicitly state this in their report and provide a description of the omitted weakness.
That seems like a vital mechanism for market integrity.
It absolutely is.
Right.
It prevents management from selectively reporting or misrepresenting the true state of their controls. Similarly, the auditor must consider the effect of this adverse opinion on the financial statement opinion and indicate whether the financial statement opinion was affected. This comprehensive reporting ensures that public investors get a full and accurate picture, safeguarding their interest and allowing for truly informed investment decisions.
Okay, let's imagine a slightly more positive scenario. Let's say a company had a material weakness. They faced that adverse opinion, a real blow to their reputation and financial health. But they worked really hard. They fixed it. They implemented robust new controls. Can an auditor come back and confirm that improvement? Can they give them a sort of all clear on that specific issue to help restore public trust, maybe outside the normal audit cycle?
Yes, absolutely. This is a really interesting and positive scenario, and it demonstrates the responsiveness of the audit profession to real-world business needs.
So it's possible.
It is. If management eliminates a previously reported material weakness and wants to communicate this positive development to the investing public and other stakeholders, they can engage an independent auditor to attest to these improvements.
And this is voluntary, not required.
Exactly. What's fascinating here is that this is a voluntary engagement, not required by professional standards or regulation. Companies undertake this because it can significantly bolster investor confidence, demonstrate a strong commitment to robust financial reporting, and potentially help mitigate the negative impact of the prior adverse opinion.
And they can do it anytime.
Yes, this type of engagement can be performed at any time during the year, which provides flexibility for companies to demonstrate remediation promptly without waiting for the next annual audit cycle.
Okay, so what does the auditor have to do in this specific engagement?
The auditor's objective here is very specific: to express an opinion on whether the previously reported material weakness has, in fact, been eliminated. However, there are strict conditions that must be met for the auditor to perform such an engagement, safeguarding the integrity of their opinion.
What are those conditions?
First, the auditor must have sufficient overall knowledge of both the company and its internal control over financial reporting to properly assess the changes. Usually this means it's the company's regular external auditor.
Okay, makes sense. They know the company.
Second, management must accept full responsibility for the effectiveness of internal control, evaluate its effectiveness, assert that it's now effective, provide robust supporting evidence for this assertion.
So management has to do their homework.
Absolutely. And present a written report that will accompany the auditor's report. This ensures management's full accountability for the improvements they claim.
Okay. And the third?
Third, and critically, the auditor's testing in this specific engagement is limited only to the controls management identified as having eliminated the material weakness.
So they aren't re-auditing everything.
No, they aren't re-auditing the entire internal control system from scratch. They're focusing their procedures just on the specific remediation efforts and related controls.
Got it. And if all goes well?
To issue an unmodified opinion, which is essentially that clean bill of health, specifically on the elimination of that material weakness, the auditor must obtain sufficient evidence about the design and operating effectiveness of the specifically identified controls that management claims have fixed the weakness.
Okay.
They must then determine, based on this evidence, that the material weakness has indeed been eliminated. And furthermore, the auditor must confirm there were no limitations on their audit scope for this specific engagement, ensuring they had full access.
So it's a focused but still rigorous process.
Exactly. It provides credible assurance to the public that the company has effectively addressed the previously identified serious control deficiency, helping to rebuild that trust and confidence.
Okay. Different scenario now. What if our financial detective, the auditor, can't even do their job properly? Maybe they're being blocked from getting information, or they simply can't obtain all the evidence they need for some reason. What happens then? Does the report just come out blank, or what's the consequence?
That's a very serious scenario known as a scope limitation, and it means the auditor couldn't complete their work as required by auditing standards.
Oh,
If the scope of the audit is restricted in a way that prevents the auditor from obtaining sufficient appropriate evidence to form an opinion on internal controls, the auditor has two main choices, both with significant implications. They must either withdraw from the engagement entirely,
just walk away.
if possible, yes, or if withdrawal isn't possible or appropriate, they must issue a disclaimer of opinion.
A disclaimer, what does that mean exactly?
A disclaimer is essentially the auditor explicitly stating that they are not expressing an opinion on the effectiveness of internal control over financial reporting. They are saying, in effect, we couldn't gather enough reliable evidence to give you an opinion, so we're not providing one.
So not good, not bad, just no opinion possible.
Exactly. It's a statement of inability, not a positive or negative conclusion.
How does the report show that?
When issuing a disclaimer, the report's language changes significantly to clearly convey the lack of an opinion and the reasons why. It will state that an opinion is not being expressed within a section titled Disclaimer of Opinion on Internal Control over Financial Reporting.
Okay.
And it will state the substantive reasons for the disclaimer within a basis for disclaimer of opinion section. For example, the introductory paragraph. Instead of saying we have audited, might say something like we were engaged to audit.
Subtle but important change.
Very. The auditor's responsibility paragraph will be amended to explain they couldn't obtain sufficient appropriate audit evidence to provide a basis for an audit opinion due to the scope limitation.
Okay.
Crucially, any language that might overshadow the disclaimer, like an extensive list of procedures they did perform, should not be used. This prevents the reader from mistakenly believing a partial audit was somehow sufficient.
Gotcha. What if they found problems before the limitation kicked in?
Good question. If material weaknesses were identified, despite the limitation, perhaps they were found before the limitation became prohibitive, or in areas where access wasn't restricted, they should still be described in the disclaimer report, and their definition included. This provides any information that was gathered, even if it was insufficient for a full opinion.
Okay.
The auditor can issue this disclaimer as soon as they conclude that the scope limitation will prevent them from expressing an opinion. And management and those charged with governance must be informed of this grave situation in writing.
Yeah, for a company, a disclaimer must be a significant warning sign. Lack of transparency, maybe operational issues.
Absolutely. It indicates something is preventing proper oversight and verification.
Sometimes our financial detective isn't working alone, right? Big companies often have lots of subsidiaries or operations in different countries, complex legal structures. Do they use different auditors for different parts of the business? And how does that affect the main audit report, particularly for internal controls?
Yes, that's precisely where a component auditor or other auditor comes in. This is very common in complex, multinational, or highly diversified audits. It's often just more practical or efficient to engage local auditors for specific parts of the business.
Makes sense.
The group engagement partner, or principal auditor, that's the auditor responsible for the overall audit opinion on the consolidated financial statements and internal controls. They decide whether the involvement of this other auditor in auditing a component warrants specific reference in the overall audit report on internal control.
So they decide whether to name the other auditor in the main report.
Right. It's about transparency to the users regarding who performed which parts of the audit work, giving them a fuller picture of the audit team.
Okay. Now, is that decision the same for the financial statement part and the internal control part?
What's fascinating here is that the decision to reference another auditor in the internal control report is independent of the decision made for the financial statement audit.
Oh, really? So they could be different?
Yes, the two decisions may differ. For instance, a principal auditor might choose to reference a component auditor for the financial statement audit of a particular foreign subsidiary because that subsidiary's financials are material to the consolidated statements.
Okay.
However, they might not reference that same component auditor in the internal control report if, say, the principal auditor sufficiently oversaw the internal control testing at that component themselves. Or maybe if the component's internal controls weren't deemed material enough to the overall internal control system to warrant explicit mention of a separate auditor.
Interesting. So the materiality or involvement can be judged differently for financials versus controls.
Exactly. This independence of decision acknowledges that the scope and materiality considerations for financial statement auditing can sometimes differ from those for internal control auditing, even within the same overall engagement. It allows for more tailored reporting to users, depending on what's most relevant for each opinion.
Okay, one last area, subsequent events. What about things that happen after the audit date, say December 31st, but before the report is actually released, maybe weeks or months later? Like if a company makes a big material change to its internal controls right after the year end, or if a new material weakness is discovered in that interim period, does our financial detective have to account for that?
Yes, this is where subsequent events come into play.
Yeah.
And the concept is similar to how they're handled in financial statement audits, but applied specifically to internal controls.
Oh.
These are changes in internal control or new conditions that occur after the as-of date of the report, like December 31st. But before the date, the auditor's report is actually issued. And as you said, this period can span weeks or even months, and significant events related to controls can indeed occur during this time.
So what does the auditor have to do about that period?
The auditor has specific responsibilities regarding these subsequent events. They should inquire of management about any significant changes to internal control that occurred during this interim period. They need to obtain written representations from management concerning these changes and inquire about and examine relevant documentation for this subsequent period.
Due diligence for that gap period.
Exactly. This due diligence ensures the auditor is aware of any developments that might affect the internal control opinion they're about to issue. Now, there are two key scenarios. If the auditor obtains information before the report date about a matter that existed on the as-of date, for instance, they discover a material weakness that was actually present at year-end, but only came to light during the subsequent period.
It was there all along, but hidden.
Right. Then they must take appropriate action, which could involve issuing an adverse opinion if it's indeed a material weakness. The report has to reflect the condition as of the as-of date.
Okay. What's the second scenario?
If they obtain information about conditions that arose subsequent to the as-of date, meaning a new internal control issue developed after year-end, but before the report is issued, say a major system failure happened in January.
So a new problem after the date being audited.
Exactly. This information should be included in an explanatory paragraph of the report. It doesn't change the opinion as of December 31st, but it ensures readers are aware of significant changes to the control environment that occurred post-year-end. It provides important forward-looking context.
That makes sense. What about after the report is issued?
Critically, the auditor has no responsibility to keep informed about events occurring after the actual date of the report. Once the report is issued, their responsibility to update it for subsequent events generally ceases. The exception would be if they later become aware of conditions that existed at the report date but were unknown to them at that time, in which case they must act appropriately to address that oversight.
Wow. Okay. We have truly drilled down into the complex but ultimately transparent layers of audit communication and reporting, from those tiny deficiencies that might just be procedural hiccups,
Mm.
to the major material weaknesses that signal fundamental structural flaws in a company's financial plumbing. We've seen how auditors communicate these critical findings to management, boards, and, for issuers, the investing public.
Yeah, it's a whole system of communication.
It really is. We've dissected how opinions are shaped and what those crucial inherent limitations really mean for anyone trying to understand a company's true operational integrity. It's clear this isn't just about ticking boxes, it's about conveying a deeply considered independent assessment.
Yes, absolutely. And understanding these documents provides a much richer and more nuanced picture of a company's financial health
Hmm?
than just looking at the bottom line revenue or profit figures.
Right. It's about knowing the plumbing of the system, not just what comes out of the faucet.
That's a great way to put it. The clear distinctions between non-issuers and issuers and the strict protocols around reporting all serve to enhance transparency and accountability. They compel organizations to address weaknesses and provide assurances to stakeholders, assurances that are fundamental to trust in financial reporting, whether that trust is needed for a private lender or millions of public investors.
And the next time you, our listener, see an audit report, especially one about internal controls, you'll know to look far beyond just the final opinion line.
Hopefully.
You'll be able to spot the basis for opinion, the responsibility sections, and definitely those crucial inherent limitations, which, let's be honest, we all need to be reminded of in any human design system.
True enough.
So what does all this mean for you? It means a well-structured audit communication is a powerful tool for informed decision-making. It offers insights into a company's operational integrity that are far more valuable than simply knowing if they made money. It's about understanding how they made money and, crucially, how reliable that process truly is.
Indeed. This detailed understanding of internal control communications is a powerful tool. It really prompts the question for you, the listener. How might this newfound knowledge empower you in evaluating financial reports, whether that's for investment decisions, establishing crucial business partnerships, or maybe simply satisfying your curiosity about how organizations manage risk and maintain financial integrity in our complex world?
Yeah.
This knowledge equips you to ask deeper, more insightful questions, to see beyond just the surface numbers.
A great question to mull over. That's all for this deep dive. Until next time, keep digging, keep learning, and keep asking those insightful questions.